Hello, a very good afternoon to everyone attending the 9th conference organized by ICMA. I want to take this opportunity to thank the organizer for inviting GIC to talk about sustainability and how we approach it in the way we invest. I'll frame my remarks into three parts. First, I'll start by sharing our beliefs which underpin what we do on sustainability. Second, instead of describing our sustainability framework, which spans across capturing opportunities, protecting our portfolio, and pursuing enterprise excellence, which you can all read from our website, I'll zoom into specifically the two areas which we are focusing on in enabling real-world decarbonization. And third, I'll briefly touch on the challenges and how we deal with them. So first, our beliefs. GIC's mandate is to preserve and enhance the international purchasing power of the reserves under our management. Sustainability is integral to our mandate and is an investment issue. Climate change is one of the biggest challenges of our generation and beyond. The stark warning of the final IPCC report was clear. While many climate mitigation and adaptation solutions are available now, the window of opportunity to meet the Paris temperature goals is closing rapidly. Climate change has material impact on the physical world and the financial world. As a long-term investor, we believe that companies with strong sustainability practices offer prospects of better risk-adjusted returns over the long run. This relationship is likely to strengthen over time as market externalities get priced in, given that regulators and businesses and consumers will all change the behavior and the actions taken. As the world moves towards key timelines, such as 2030, 2040, and 2050, where pledges and commitments are made, we should expect to see a significant increase in intervention and efforts from governments, regulators, and businesses in order to meet those commitments. For example, Singapore announced a progressive increase in carbon tax from the current $5 per ton of greenhouse gas emissions to reach between $50 to $80 per ton by 2030. That's 10 to 16 times in a short span of 7 years. These changes in regulations are happening everywhere globally in different shapes and forms and with greater urgency. So we believe that for companies to be profitable in the future, they have to be sustainable. Second, we believe it's important to take a holistic and long-term approach towards sustainability. As a global investor operating in different markets, we recognize there could be inherent conflicts and trade-offs in the various sustainability objectives, especially in the shorter term. We believe it's important to integrate sustainability considerations in a way that recognizes the idiosyncrasies and the diversity of the industries and markets in which we operate, and the trade-offs and time needed for companies to make the transition rather than mechanically divesting from certain industries based on a blunt top-down approach. Third, we believe it's important to play a constructive role in enabling global transition towards net zero in the real economy through our investments and operations. The emphasis should be on the real economy transition and the impact and transmission mechanism of our investment activities on the real economy. We aim to drive impact in the decarbonization in the real economy in two ways. One, investing in emerging climate solutions and technologies, and two, supporting companies to transition towards more sustainable business practices and models through active engagement with the companies and financing strategic projects. Next, let me elaborate more on the two sustainability efforts. Based on IEA's research, to achieve the net zero emissions by 2050 scenario, transition in the real economy will require $126 trillion of additional capex funding from now until 2050. And this is to decarbonize electricity, transport, buildings, and industry. Almost half of this money, or 56 trillion US dollars, is needed in the Asia Pacific, which reiterates the significant potential of investing in the transition pathways of emerging markets. The first pillar of our strategy is to invest in emerging climate solutions and technologies. We set up the Sustainable Investment Fund about 3 years ago to pick companies and winners that will thrive in the ESG world from across asset classes, from debt to equity, public to private, internal to external. This fund has since catalyzed the development and growth of dedicated sustainable investing efforts in many of our bottom-up investment teams across asset departments. Today, our sustainability-related investments are wide-ranging, from technologies such as carbon capture, green steel, or long-duration storage in our PE investments, to EV charging infrastructure or green fuel in the case of our infrastructure investments, to ESG data provider in equities, and debt financing for a firm working on geothermal energy solutions. This breadth allows us to invest in multiple innovative solutions, but also support firms at various stages of development. Some of the technologies are nascent. While we do try to identify these opportunities early on, these solutions currently still make up a small sleeve of our investment universe. What is therefore equally, if not more important, is the second pillar of our strategy, which is to actively support and engage companies with credible plans to transition from high carbon to more sustainable business practices. For example, we're invested in AC Energy, the renewable energy platform of the Ayala Group in the Philippines. AC Energy has pledged to achieve net zero by 2050, and GIC's investment will be used to fund the platform's renewable energy project development and potential acquisitions, enabling it to accelerate and expand its green impact. Our portfolio managers also actively engage company management to support their transition through responsible voting and regular dialogues, amongst others. We collaborate with fellow asset owners through platforms such as the Asia Investor Group on Climate Change, or AIGCC, CDP, Climate Action 100+, to encourage companies to make sustainability disclosures and take steps to manage their transition risk and climate impact. For example, we are a pioneering member of the AIGCC Asian Utilities Engagement Program. Through the program, we have seen Asian electric utilities stepping up their commitments to decarbonize their operations. For instance, CLP Holdings committed to phase out coal by 2040, while Tenaga National Berhad and PLN committed to net zero by 2050 and 2060, respectively. Finally, I'll touch on the two key challenges in our sustainability journey and share how we deal with them. First, we recognize that the path to net zero is unlikely to be smooth, and along the way, some trade-offs may be needed. This is certainly not a trivial challenge. For example, in some emerging markets, including Asia, coal-fired power is still the most affordable source of electricity, and early retirement of the relatively young coal plants is economically challenging, especially as countries scramble to meet rising energy demand. The transition to cleaner power could take longer, and it also depends on the pace of actions by a range of different players. In our underwriting of investments in these markets, we seek to understand how serious the companies are on their transition plans and whether they're moving in the right direction and at the right pace. We advocate a more holistic approach that integrates both top-down and bottom-up assessment and seek to be a constructive partner in supporting companies in their transition journey. Second, deep sustainability integration requires good data, the availability of timely, relevant, consistent, and comparable sustainability data. Data remains a common challenge for investors across public and especially private markets. We have been supporting portfolio companies to improve their evaluation and disclosure of financially material sustainability issues and have also invested in ESG data providers dedicated to improving the ecosystem. But ESG data and measurement remains an alphabet soup. We welcome the launch of ISSB standards earlier this week, which set out a global baseline for sustainability disclosure focused on information relevant for investors' assessment of the enterprise value. We believe this provides a practical solution to help companies bridge the disclosure and data gap. In conclusion, sustainability remains a rapidly evolving space, and GIC has much to learn and improve upon. We need to continue to adapt our investment strategies, build our toolkit for identifying risks and opportunities, drive better integration across asset classes, and deepen our engagement with companies. These efforts are all resource-intensive, and the journey, frankly, has been very difficult. But we are privileged to be part of this global community of like-minded investors with whom we can exchange ideas and learn from. By collaborating on areas such as research and corporate engagement, we hope to amplify our impact and our own efforts and create more opportunities to accelerate the decarbonization of the real economy. Thank you.